In this market, what truly makes you restless isn't where price goes. It's that even after the most important data is already out, you still can't confirm whether the next step is a continuation of the trend or just an emotional exhale. Hey everyone, I'm Peter. Today is January 10th, 2026. Let me make the conclusion clear up front. This jobs report isn't a strong bullish catalyst, but it removed the layer of uncertainty that made the market feel the worst. If your trading rhythm has felt awkward lately, it's not that you've become hesitant, it's that the market is moving from extremely afraid to make mistakes into okay to probe in small size. All three major indexes closed higher, with the S&P 500 making fresh highs. But that wasn't because the data looked pretty. It was because the most important risk checkpoint has now landed, and it didn't break the market's core narrative. What the market truly needed wasn't a perfect jobs report, but no surprises. The profile of this report is very clear. Employment is cooling, but not out of control. The economy is slowing, but not crashing. Once uncertainty fades, the VEX pulls back and actually creates more room for risk assets. You need to realize that what the market is trading has already changed. It's not rewarding good news, it's punishing uncertainty. Before the jobs report, capital's biggest fear was, what if something goes wrong? After the jobs report, as long as it confirms nothing went seriously wrong, even a merely passing score can still get positive feedback from the market. So what you're seeing isn't a growth story, it's a survival story. Structurally, job gains came in below expectations and prior numbers were revised down, showing that the labor market did weaken toward the end of 2025. But the unemployment rate fell and wage growth stayed firm, which offset the negative read from softer hiring. Put together, the signal is very clear. Companies have entered a freeze mode. No expansion, no layoffs, growth is slowing, but the system remains stable, and that's exactly why the soft landing divided by Goldilocks framework can still stand. A lot of people see slower hiring and immediately connect it to, does that mean rate cuts should happen right away? But you have to separate timing from direction. Soft doesn't equal danger, and cooling doesn't equal losing control. The labor market right now looks more like businesses collectively tapping the brakes, not slipping off a cliff. For the Fed, that's precisely a we can wait and watch condition, not a signal that demands immediate intervention. What the Fed whisperer said essentially reinforced the logic for the Fed to stay put in January. Rate futures still maintain expectations for multiple cuts in 2026, but the probability of a January cut is close to zero, and the first cut has been pushed back toward mid-year. The market isn't disappointed, because this isn't a reversal of policy stance, it's a recalibration of timing. This is exactly why I say the market feels mature right now. It's no longer betting on a dramatic pivot at tonight's storyline, it's recalculating probabilities. And you can see it in the behavior. The VIX comes down, meaning the most annoying variable has been dealt with. But positioning doesn't get slammed on all at once, meaning capital isn't in a hurry to prove how optimistic it is. It acknowledges risk is lower, but refuses to get overconfident. Comments from a White House advisor about needing further rate cuts, along with a potential candidate signal, were interpreted by the market as an opening of longer-term imagination for more dovish political influence. This narrative is especially stimulative for Bitcoin because BTC is highly sensitive to liquidity expectations. Price surged quickly, but structurally, this looks more like sentiment repair near a support zone plus short covering, not a confirmed trend. Political statements like these are, in essence, just sparks. It's normal for the market to react first, but you should never treat a spark as an engine. You can look back at similar episodes whenever it involves vague messaging like potentially more dovish or future policy space. Risk assets usually move first, especially instruments that are extremely sensitive to liquidity like Bitcoin. The Supreme Court has not yet issued a ruling on the tariff case, and the next key observation window falls on January 14th. From the index level, the market's response has been quite restrained, suggesting that capital is not treating it as a medium-term trend variable, but rather placing it in an event-pending drawer for now. But at the sector level, pressure on tariff-sensitive stocks still exists. Sentiment remains weak in areas like Nike, autos, apparel, and toys, reflecting uncertainty on the cost path at the company level. This is where a lot of people make a mistake. They see the index staying fine and conclude the issue doesn't matter. But the market is never one size fits all. An index is a composite. It can offset with tech or financials. An industry or a single stock doesn't have that cushion. For a sector, policy uncertainty itself is a cost. You need to understand one thing. Tariffs are noise for the index, but they can restructure a company's profit model. From a technical structure standpoint, QQQ did complete an upside break above its consolidation range, but trading volume did not expand meaningfully. That means the pattern is giving a constructive signal, yet capital is still keeping some doubt. In this setup, the market typically evolves in only two ways. First, it retests the breakout level, confirms, and then continues higher. Second, it becomes a false breakout and returns back into the original range. So, with the jobs report just behind us and earnings season not fully underway yet, the trend still needs time to prove itself. Here's a very important truth that many people don't want to accept. The market doesn't owe you an immediately smooth move. A lot of traders didn't get the direction wrong, they lost on timing, so my stance is always clear: you can respect the trend, but don't chase it emotionally. You can worry about risk, but don't fight risk by going aggressively against the tape. The current upside structure is clearly spilling over. The Dow's relative strength suggests broader participation, not just a few mega-cap tech names propping the market up. Meanwhile, the Dow approaching the psychological 50,000 level often comes with slower tempo rather than a trend reversal based on historical experience. A healthier evolution would be digestion and consolidation at high levels while waiting for the NASDAQ or more sectors to follow through, so the rally becomes more sustainable. This point directly determines what mindset you should use next. A rally driven only by the Magnificent Seven is fundamentally single-point force. It can work short-term, but system stability is weaker. When you start seeing the Dow, cyclicals, and some non-tech areas participate, it means the market is trying to shift from sentiment-driven to structure spreading. With the S&P nearing 7,000 and forward, P divided by E in a high range, the market is already pricing in a relatively ideal earnings environment. Valuation itself does not mean an immediate pullback, but it significantly reduces the margin for error. In this backdrop, any earnings disappointment can produce amplified price reactions. However, based on the current macro and sector distribution, you do not believe earnings season alone is enough to trigger a systemic pullback. An external shock would more likely be needed as a catalyst. At high valuation levels, I prefer to think of the market as being in a picky state, like a house priced at the top end. It's not that it can't sell, but buyers become extremely strict. Earnings season is the inspection process. If there are no issues, the price can hold. If there's even a small flaw, the bargaining power expands instantly. So what you need isn't premature panic, but clarity. The market's tolerance for mistakes is going down. Next week, banks will be the first to kick off Q4 earnings season, including JPMC and GS. The market expects overall S&P EPS growth around 8%, with tech still viewed as the primary driver and energy potentially weaker. Options markets show an average implied move around 5% for earnings names, meaning earnings, weak price swings will be significantly amplified. In this phase, capital emphasizes confirmation rather than betting early. The biggest trap in earnings season is that it makes you think, as long as I get the direction right, I'm fine. But in reality, what earnings trading tests is not right or wrong, it's how the market interprets it. Great results, no rally. Mediocre results, a surge. This is very common in a high valuation regime, so during earnings windows, rhythm and position sizing are often more important than being right on direction. The housing chain is driven by policy imagination, and high beta names are more likely to be chosen by capital. Nuclear and power reversed in sentiment as Meta expanded nuclear procurement. The AI chain gained confidence as TSMC revenue beat strengthened 2026 spending expectations, and APLD's technical structure confirmed a breakout. Semiconductors showed clear internal divergence, with INTC supported by political narrative while AMD lagged, and capital favored the steadier narrative choices. When you stitch these threads together, they really point to one thing: the market is using different tickers to express the same framework. Capital isn't only looking at what industry you're in, it's looking at whose narrative is clearer, whose positioning has more elasticity, and who is more suitable as a vehicle to express expectations. I'm Peter. If you're interested in my work, please hit subscribe. Thank you.